worth of almost $5 million just to get a meeting with our next guest, but we're bringing you his investment advice for free. Joining us now on the phone is Jeff Weiler, the Pacific Wealth Group Senior Vice President. Sorry, Jeff, we couldn't get you on screen. I know it's not ideal, but we are happy to have you here today.
Thank you for having me. You just won't get to see my smiley face.
Well, we can hear your smiles coming through the phone. Tell me about how you are positioning your investment advice right now. The markets are down 130 points. Gold is up, a lot of volatility. So what do you like here?
So we tend to run a fairly defensive portfolio. Myself and three partners make the decisions in a portfolio that has a little stock exposure, a little bond exposure, alternatives, and cash. And we'll tend to over or underweight those various asset classes depending on what we see. And we've had positions in some of the precious metals, including gold and silver over the last year. We continue to like that. And we see some definite risks in some of the traditional asset classes, including longer term, traditionally safe treasury bonds, and various investments like that.
All right, there are a lot of risk in traditional asset classes, as you mentioned. So how do you hedge or protect yourself and your clients from that risk?
Well, what's important to understand is we primarily work with second and third generation family businesses and wealthy families, as well as nonprofits, institutions, and we tend to walk them through a very thorough forward-looking cash flow analysis when we get started working with them. And this tends to determine a target rate of return that we want to focus on when times are as volatile as they are now and what we've seen in the last 3 years. So when we have these market crises, if you will, we want to remind them to focus on their target rate of return instead of chasing any particular index like the popular S&P 500 that doesn't really have objectives, time horizons, or client needs like our clients do.
You know, Jeff, a lot of people watching the show try that kind of stuff too, and they say, well, you know what, I've tried this one approach and it hasn't worked for 1, 2, 3, 4, 5 years. Is there a point where you say, okay, we've got to tweak the defensive portfolio, or, one of the things I noticed you guys look at, you talk about the full economic cycle. It feels like all of that stuff's been turned upside down. So when do you decide to make changes to the program? When do you decide that maybe it's not working?
Well, when we get started with clients and we take them through that process, we tend to look at them being a client for a long period of time, and that gives us the opportunity to look at the full economic cycle and a much longer term period of time to determine where risks are. And sometimes it takes time for those risks to bear out and for the opportunities to bear out. So we're hesitant to make shorter term decisions based on market movements. Most all of the investment debate that my three partners and I have is to protect capital and to be defensive, and again, to not measure ourselves against an S&P 500 or other index, but to measure ourselves against target rates of return and client needs over a full market cycle. That's not to say that we don't make short-term moves when, for instance, in 2008, or that we don't look at opportunities in the marketplace, but again, we're making short-term decisions much less frequently than longer-term decisions, and rarely will we make a bet. We don't want to completely move out of an asset class or into an asset class. It's really just tweaking the asset class percentages in our model portfolio.
All right, got it. Thank you, Jeff Weiler from Pacific Wealth Group. We'll get you on in our network here next time. Hope to see you again soon.